Picture this. You've been paying your mortgage for 30 years. 30 years! And one day, you make that final payment. You hang up the phone, sit back in your chair, and just breathe. You did it. The house is yours. No more mortgage, no more lender, just you and the home you built your life in. And then, about 30 days later, an envelope shows up in the mail. Property tax bill. Then another one. Insurance renewal. And you're doing the math and thinking, wait, why is this still so expensive? Here's the thing. This reaction is one of the most common things people experience after paying off a mortgage. The shock that the costs didn't disappear. They just changed shape. Now, I want to be clear right away. This video is not here to scare you out of homeownership. Quite the opposite. Owning your home free and clear is one of the greatest financial milestones you can hit in a lifetime. This video just makes sure you cross that finish line with your eyes wide open. Because the people who get blindsided, they just didn't know what was coming. Today, you will. We're going to break down exactly what these costs are, how they're calculated, what they actually run in real dollars, and most importantly, how to build a plan for them starting right now, before your mortgage is even gone. So why does this catch so many people off guard? One word: escrow. Here's how it works when you have a mortgage. Your lender doesn't just let you pay your property taxes and insurance on their own. They collect a portion of those costs every single month as part of your mortgage payment, hold it in an account, that's the escrow account, and then pay those bills on your behalf when they come due. The result? Most homeowners never actually see these costs. They're just baked into the monthly payment. It's automatic, invisible. You pay $1,800 a month and never think twice about the fact that $600 of that is quietly covering your taxes and insurance. Then you pay off the mortgage. The escrow account closes. And suddenly, you're responsible for paying those bills yourself, often in large lump sums, semi-annually, annually, not a quiet $600 a month, a $2,400 check in the spring, and a $2,400 check in the fall.
Here's a concrete example. Say your annual property tax is $4,800 and your homeowner's insurance is $2,400. That's $7,200 a year. When it was in escrow, you barely felt it. Now it shows up as 2 or 3 large bills throughout the year, and if you haven't been setting money aside, it hits hard. The costs were always there. You just never felt them directly. Now you will. Let's get specific about property taxes, because most people have no idea how they're actually calculated. Your local government assesses your home, meaning they estimate what it's worth for tax purposes. That number is called the assessed value. It's not always the same as what your home would sell for on the open market. It's the government's own figure, updated periodically, and it can move up over time. Once they have your assessed value, they apply something called a millage rate. That's the tax rate, expressed per $1,000 of assessed value. 1 mil equals $1 of tax per $1,000 of value. So if your home is assessed at $350,000 and your local millage rate is 14 mils, your annual property tax is $4,900. The math: $350,000 divided by 1,000 times 14. That's your number. Now here's the part people underestimate. That assessed value gets reviewed regularly, sometimes every year, sometimes every few years. And if your home's value goes up, your tax bill goes up too, even if you haven't touched the property, even if you're not planning to sell. The tax follows the value. One thing worth knowing, many states offer what's called a homestead exemption. If the home is your primary residence, you may qualify for a reduction in your assessed value, which lowers your tax bill. It's worth 5 minutes to look up whether your state and county offer this, and to make sure you've applied. A lot of people miss it simply because they don't know it exists. And here's a reality check on geographic variation. Property taxes are not consistent across the country, not even close. A $350,000 home in New Jersey might carry $8,000 to $10,000 a year in property taxes. That same home in Alabama might be $1,500 a year. National averages are nearly useless for this calculation. What matters is your number in your county. So here's your action item from this section. Look up your actual property tax bill today. Not an estimate, not a ballpark, the real number. It should be on your county assessor's website or right on the bill itself. All right, let's talk about homeowners insurance. And let me say this up front. Even without a mortgage, going uninsured is not a financial risk. It's a financial catastrophe waiting to happen. Your home is likely your largest asset. You do not want to own it naked. But most people don't actually understand what their policy does or doesn't cover. The first thing you need to know is the difference between actual cash value and replacement cost value. These are the two main types of coverage, and the gap between them can be enormous. Actual cash value, or ACV, pays you what your belongings are worth today, after depreciation. So if your 5-year-old TV gets destroyed in a fire, you get what a 5-year-old TV is worth now, not what it costs to buy a new one. Replacement cost value, or RCV, pays what it actually costs to replace the item with something comparable and new. That's a very different number, and for a major loss, it could mean the difference of tens of thousands of dollars. Check your policy. Right now, if you're not sure which one you have, go check. This matters. Standard policies typically cover the structure of your home, your personal belongings, liability if someone gets injured on your property, and additional living expenses if your home becomes uninhabitable. That's your base coverage. What they typically do not cover, floods and earthquakes. These require completely separate policies, and they're often overlooked entirely until the moment you need them most. And one more thing on insurance. It is not a fixed, stable cost. Insurance premiums have been climbing sharply in recent years, particularly in coastal states and areas with increasing wildfire, hurricane, or flood risk. You cannot assume your premium next year will look like your premium this year. Which leads to the action item here. Don't just auto-renew your policy. Review it annually. Shop it around. Getting a competing quote at renewal takes maybe an hour of your time and can save you hundreds of dollars a year. Do it. Let's put it all together with real numbers so you can see what this actually looks like. Take a home where the annual property tax is $4,800. That's $400 a month. Add homeowners insurance at $2,400 a year. That's another $200 a month. If you're in a flood zone or an area that warrants a separate policy, add another $1,200 a year, $100 a month. Total, $700 a month in housing costs, with zero mortgage. Now, that's not a scary number. That's actually a reasonable number, but it is a real number, and it's one that you need to build into your financial plan before your mortgage is paid off, not after.
The goal is simple. By the time that final mortgage payment clears, you should already be setting aside the equivalent of your property taxes and insurance every month in a dedicated account ready to go when those bills arrive. No surprises, no scrambling. Just a system that works. Let's recap the 3 things every homeowner needs to have clear in their head. 1. Escrow is hiding these costs from you right now. While your mortgage is active, your lender handles your property taxes and insurance individually. The moment that mortgage is paid off, those bills are yours to manage directly, often in large, infrequent lump sums. 2. Property taxes rise over time, and they vary dramatically by location. A national average tells you almost nothing useful. Know your exact number in your exact county, and be aware that it will likely increase as your home's assessed value increases. 3. Homeowners insurance is non-negotiable, even without a lender requiring it. Understand whether you have ACV or RCV coverage, know what your policy doesn't cover, and review it every single year instead of just letting it auto-renew. Paying off your mortgage is one of the greatest financial milestones of a lifetime. I mean that. This video just makes sure you get there with eyes wide open, not shocked by a bill you didn't see coming. And one last time, link to the newsletter is in the description below. Free, daily, under 5 minutes. Worth it. If this video changed how you're thinking about your housing costs, share it with someone who's close before it's too late.
Subscribe to the channel if you want to understand money better than most people around you. Here you will learn not just to earn, but to manage your finances so that they work for you. Watch the next video and take another step towards financial freedom.